So Lemonade Q4 2024, the earnings letter is up. We're excited as Lemonade investors. We finally found out how they're doing, how the LA fires turned out. So I'm going to talk in this video. It's going to be a really free-flowing video. I'm going to just share and give a little more detail, thoughts about a number of posts I made in a thread regarding the letter. We're going to look at additional graphs, details, things from my Lemonade model. And then, really hammer home the questions I hope that management touches on in the earnings call tomorrow. So let's dive into it here. And again, going to sort of free flow share thoughts I've been reading, ruminating on the letter here for the last few hours since it came out. And first of all, obviously they had still decent growth, right in line or just above where they were guiding, 944 million. I was estimating too high. It was in the 950s, but I was too optimistic, but still solid growth. Premium per customer, 388, and the total customers is actually kind of higher than I was expecting. It must show they're still really growing with the pet renters, I think, sort of profile more than anything. Still seeing a lot of success there as they're growing versus other products such as car product, is a big question we're going to sort of touch on. But 2.4 million customers already, massive growth there. And if you look at it here, they had adjusted gross profit was at 66 million in Q4, and just a year prior 35 million. So nearly doubling, and the year before that 18 million. So nearly doubling. A big part of reason why that occurred is because the loss ratio was so good, as I was expecting, hoping, thinking. I was saying, I think it's actually going to be less than 65%. I kind of was guessing 63%, which is doesn't show it here, but is right where the gross loss ratio came in at. Now, if we look at, first of all, we'll sort of look to the future, their guidance for Q1 and full year 2025. They did guide around that, there's about 28% growth. So somewhere just over 1.2 billion. I thought this was going to be quite a bit higher. I still think, and I'll be looking at this closer in other videos, I still think there's a very good chance they easily exceed this number, but we'll look at that closer in some other videos. Another thing people were saying, part of the reaction here is that the stock was trading, it was down already today big, and down to 32 at the close, and then after the close went from 32, report came out and dropped down to 26, 27 sort of range. So pretty significant drop. And some people wonder, well, maybe that part of that is adjusted EBITDA loss for 2025, still a minus 140 to minus 135. Big reason why you have that kind of a loss, because in my own model, and I haven't updated at all actually 2025, but if you're looking ahead for adjusted EBITDA, this line here for 2025, I have a model that is 132 million. So it's not, the range they gave here is not crazy, and they tend to always beat even the optimistic end of their guidance. So it wouldn't be surprising to see like a $130, $125 million loss. And big reason why this, is because they're investing or planning to invest so much into growth, because they're planning to invest 40% more in growth next year, 2025, versus 2024 was. So I flip back to my model again, and if you go to growth, customer acquisition spend here, we're at 121.5 million for 2024. So let's say 121.5 times by 40%. They're planning to spend, around $170 million on growth spend next year versus, the 121 last year. So if you say you didn't spend anything on growth, you can see that next year already they're going to be they would be adjusted EBITDA profitable in 2025. If they spent even just a small amount on growth or nothing on growth at all, they would be adjusted EBITDA profitable, as they already were in Q4 as well. So the reason, as you're ramping up that growth spend, you're always investing and pushing for the future, and then it temporarily makes your numbers look worse. A lot of people can't see past that. A lot of people that are skeptical are barely maybe sort of legacy insurance analysts and are not used to thinking about growth companies, thinking about heavy investment into the future and how that's going to pay off in the future. And in the sort of meantime, immediate focus, they can't see past that. So that's a really big thing to understand, though. So that's a big reason why this value, I don't think these values are crazy, though that might be maybe the market, it's worse than analysts were possibly expecting, and shows that there. So moving on, another thing from the letter here I pointed at was, a big question for me is, how does the LTV to CAC hold up as you scale, as you increase your growth spend from 50 some million 2023 to 120 million last year to 170 million this year. How is this going to hold up? And I saying scaling our ad spend dramatically while maintaining an LTV to CAC above 3-to-1 and a triple-digit customer acquisition IRR. The upshot: 5 consecutive quarters of IFP growth acceleration. So basically just saying, hey, their IFP growth rate is slowly accelerating. That continues to accelerate. This year they're planning, again, they showed 28% at the end of the year. I really think it's going to be, higher than that, more like 30%, maybe even low 30s. But we'll look at that further in another video. But this is really encouraging to see this, and I'll also look at some of my own math around this as well here in the video as well. And gross profit is growing, like as I pointed out before, pretty wild. Gross profit, just a measly 90% year-over-year growth. Now, big, huge reason again for that is because your loss ratio, it's going from, gross loss ratio, at least on the gross side, is, let's see here, gross loss ratio 63%, and we went at 77%. So it's just continuously trending down. In Q4, obviously a really, really good quarter. Q1, I haven't done the math on it. I just have 75% in there as a figure right now, but we know with the LA fires, that is going to be a temporarily worse loss ratio. But operating leverage continues. So if you look at all their operating expenses, excluding growth, a lot of people, on the bearish side, they can't seem to fathom that you'd have a metric like this, or they just think the sort of worst of people. They think, oh man, those managers at Lemonade, they put OpEx excluding growth. That's because they're trying to hide your growth figures. I mean, that's literally the sort of argument I've read or see from some bears on Lemonade. And no, it's very easy to understand why they're doing this. Management shows you operating expenses excluding growth because this is really all your overhead, other fixed expenses. In this $88 million line. This is all your other OpEx. And then as you're fueling growth for the whole book of business, that's the one variable, your variable expense that you really can control. And you can push forward or you could dial that back. You could spend nothing on ad spend next year and, like I said, already become adjusted EBITDA profitable, or spend, lots and you continue to invest for the future to healthy LTV, lifetime value to customer acquisition costs. So you're spending however much to get a present value, sort of a gross profit from those customers. So it's really obvious why management does this. Is because it's a really useful metric to see, hey, your expenses are flatlined and this trend continues. Now, I think a more nuanced bearish take, and I think this is a fair criticism of a graph like this, or caution maybe of a graph like this, is that you could say, hey, it's great that this line is flat, and then you could say the only reason it's flat is because you have overcapacity already. So in all your administrative departments, your customer service departments, all those other, those legal teams, et cetera, et cetera. So you could just say, hey, you already have more people than you need, even then and still now, and you're at some point, maybe it's 1.5 billion of IFP, whatever it is, you're going to hit a wall, and then this bottom value is going to have to start to climb. Well, I mean, I think that is actually a legitimate criticism. It's funny though, because I don't even hear bears bring that criticism up or articulate that. But I think that's a fair criticism because we don't 100% know if that will or will not happen. As a bull on the stock, we believe, and as we watch, that the real details that Lemonade shows us at Investor Day and the examples they give us and the ways they're implementing technology and artificial intelligence and using large language models with, to receive phone calls and completely interact with your own account in a seamless, secure way with, no additional headcount or additional costs on top of the technology costs you've already invested, et cetera, et cetera. If you think about it in that way, then you think, yeah, they're going to have massive operating leverage, and they're really going to scale this to, they're going to scale up to that $4 million of IFP per employee kind of figure eventually, like they showed us at Investor Day. That would be the bear take. That's what I think is going to happen. And this, this bottom line is just going to incrementally, slowly, very slowly trend up over time, but much, much slower rate than the top line. But that, that's a little aside, little tangent. I think that is a legitimate thing we do not know as bulls, and I don't even hear that from the bears. But I don't even think it's. I also don't think it's going to be a problem for the reasons I just discussed there. Okay, moving on. LA fires are not too bad. I said so. The $45 million in gross losses, adjusted EBITDA impact of approximately $20 million. I mean, these LA fires are obviously not insignificant losses. They are substantial. But if we flip to this spreadsheet and I brought up when we were doing, had the LA fires video, and you say there's a $25 billion total loss. Lemonade has 0.2% of the entire book. Say for example, 100% of their book is in the affected zone. So their book is spread evenly across California, and they have some losses there. And that could be some renters insurance, maybe some homes that they had insured, maybe some cars that were damaged by fires or smoke, whatever it was. And say reinsurance covers approximately 50%, then you have a total loss of $25 million. So I think the way we approximated it, I mean, it was clearly, obviously an approximation, but I don't think the fires really are going to be a nothing. Like I said in that video, and I think it turned out to be true, the fires are going to be a nothing burger in the grand scheme of things. There was bears sort of trying to throw FUD around saying like there's going to be hundreds of $1 million in losses and Lemonade's going to be absolutely pillaged and screwed and bankrupt, etc. It's like, no, that didn't happen. This is going to affect Q1 numbers, might even affect other, further down the road, Q2 numbers too, or on and on and on through the, this year as there's sort of a trickle or slow tail of claims that come in. But this is not a massive asset. This was interesting as well, and I know Domian was definitely very curious to know this, and I have to sort of follow up or look back at some of the analysis he's been doing. But he said, management said, we're able to share that from our first 3 cohorts, that would be the first 3 months, because the cohorts were done for the synthetic aging program. That is, they're done from Q3 2023. They've been repaid in full. So those loan from those, even though that was only from a year and a quarter later, those loans were already paid back. So now those cohorts, you think about it, they didn't have to put out any of their own capital to acquire those customers, but now they're getting the remainder of those customers. Of course, some have churned away, but some have remained. The remaining value of those customers they get to fully receive and accept. Total cash is continuing to rise. Of course, I'm sure the bears with, the sort of book value bros are going to come at us and say, hey, look, the book value continues to decline. Actually, I was thinking about it. I don't have it created here, but it'll be interesting to look at book value as a function. If you had sort of an adjusted book value, you called it, and part of your adjusted book value, you included the estimated lifetime value of the customers that you're getting onto your book. So if you added the present value of your customers, each quarter by quarter, and you stack that up, your book value, sort of as an adjusted book value, would look very different than typically what the bears show us and complain about. But they're still not profitable, but they are on a cash flow basis. The cash is coming in now. Of course, that's partly because they're using the synthetic agent program. But as you can see, synthetic agents programs are going to be paid back, and then they'll return. The Lemonade is able to protect their cash pile while still really putting pedal to the metal and growing. So for that reason, it's a really, really great program. I love that they gave this level of detail again. I hope this continues for each quarter from management. And a few comments I made here was, net loss ratio gross loss ratio was 63%. Net loss ratio was actually 62%. Cat exposure, as I talked about in my video preview for this quarter. I was saying catastrophic events from other insurers look really, really low. So again, are going to be really insignificant. So we only had 1% there. Loss adjustment expense, actually, that's pretty interesting. I hadn't noticed this, didn't mention up here, but loss adjustment expense, which is the portion of your loss ratio. So the portion of, loss ratio, if you're not familiar with, if you're new to Lemonade, loss ratio is the portion of your premiums that are paid back to your customers to cover claims. Now, a part of your loss ratio, your loss adjustment expense, is the portion or percentage of your premiums that is used for handling the claims. So Lemonade's at 8% here, and they're down from 9%. So that's actually having just a 1%, knocking 1% off that is kind of like knocking 1% off your loss ratio sort of indefinitely forever, because this is sort of a baked-in overhead of administrating the claims that come in. Sorry, I don't know if I explained that correctly. Loss adjustment expense is the administration of your claims that come in. So if you have to investigate whether a pet claim is legitimate or not, you have an investigator look at it, that would be part of your loss adjustment expense. Now, Lemonade can use AI to do that. Maybe they have some small costs for running that AI, but it's marginally, smaller costs and incremental, and it doesn't scale in the same way that human costs would. So they'll be able to probably even drive that down further. Other things to note here, car loss ratio is down to 83%, which we knew there was sort of a one-time, before it was 92%. Again, some bears attacked that and said, yeah, the car is ridiculous. They can't grow cars at 92%. Well, actually, if you read the previous quarter's letter, the management said that they're within the 92%, about 10% of that was from one-time expenses related to the Metro Mile book of business. So down to 83%, and I assume that's only going to decrease further. Europe gross loss ratio is also at, right here, 75%. I don't know why. That would be really interesting. Imagine make some comments on that. I don't know why that had such a drop from 100% to 90% down to 75% just in one quarter's time. Really significant improvement, and maybe because of that, maybe we'll start to see further or sort of acceleration of the growth in Europe's book of business. Europe went from 19 to 24 million, so we added 6 million of premium there. Maybe we're adding 6 to 10 million, call it 8 million each quarter. Maybe we're adding 30 some million of IFP and just in Europe over the next year, and then probably continuing to accelerate beyond that. One really concerning figure here, though, and I hope I'm going to sort of hammer this home throughout this video, and I hope we hear more tomorrow, but the car is only 5 million of car growth. What is going on with car? Car is really one of the most significant products they really need to prove that they can succeed at and be best in class at and cross-sell into. So only 5 million. And, if you think back, the start of the year, we actually had 123 million, and then we're at 100. We dropped a bit, probably as they maybe had some unprofitable car customers they dropped, and maybe that was a mixture. Maybe they were still dropping unprofitable car customers in certain states and then gaining really profitable ones in other states. But was frustrating. That was by far the only frustration really I have with this quarter was, why was there not more discussion about car? So there was really nothing in the letter. If you scan the letter for the word car, there's just like the regular standard comments come up. There's no other discussion about it at all. So my goodness, I hope we hear some car discussion tomorrow, but maybe that's an answer. I'm just speculating right now. Maybe they're dropping car customers, say in California, where it's a very poor regulated state. It's difficult to really be an insurer there and to have pricing where you want it to be. And so maybe there's dropping customers like that from the Metro Mile book of business that they had, and they're gaining in other states. And if that's the case, you might see the slower increase in the IFP, but then the car loss ratio might continue to drop, and suddenly maybe this drops to 70%, by mid next year. Who knows? But that's some, interesting stuff there. Moving on. And almost my next tweet, I said almost nothing in the letter about car. Fortunately, my car say questions vote is highest. They're even higher than this. It's like 200 and some thousand shares and 50 some votes or something was the last I saw. So I'm for sure this question is the most upvoted, or questions about car. And I really hope that Daniel Shy, whoever gives an answer here, just gives us some thoughtful, detailed answers, because these are some really important questions I think are on a lot of people's minds. For example, the questions here: what are the detailed strategy for converting 700,000 car customers? So you have 700,000 car customers on the wait list. So say 700,000 times by 1,800 was the average they gave for the premium per customer for car. You're talking 1.2 billion. Say that's not realistic, but say they all converted. That's 1.2 billion of IFP. Say even, only 10% of them converted. You're still talking like 126 million of IFP you're getting with no additional customer acquisition costs. That could be massive growth, of a huge chunk of your growth over the next year without having to spend anything. So maybe is it the loss ratio is not high enough? They don't want to convert those customers yet, and maybe that's going to come soon in the next few months. Just some detail there. And that ties into the second question. Excuse me. What's the expected loss ratio for new customers who signed up today? So not previous customers, but people signing up right now are, in Washington or whatever states they're trying to push most aggressively. Are they expecting they're already at 75% for those customers, or even better? How's that looking? And then what methods are you using to grow car and the overall brand beside incremental marketing spend? That could be related to even the billboard campaigns they have. They have other kind of scrappy viral marketing campaigns, dreams, hopes, things they're thinking of doing, or ways of growing and measuring effectiveness of marketing channels and spends within that. Some more things here. Moving on, net investment income was higher than I thought. That's 9.4 million. That'll be something to really watch, and I'll probably have to update my model because that was more significant than I was expecting. The rest of the posts in this thread are all in my Lemonade model, which is available to my Patreon members. If you want to join my Patreon, it continues to grow. We have over 100 and some people now in the Patreon, which is absolutely wild, and I hope I can keep creating value for you guys if you want to join my Patreon through the model and through other exclusive content that I'm posting there. So flipping through some more of these graphs in my Lemonade model here, I just have the model duplicated a bunch of times with a bunch of graphs and different charts I want to show you guys. So first of all, your LTV to customer to CAC, or lifetime value of a customer to customer acquisition cost. Now, on a quarterly basis, and I'll explain here, try and give explanation of how I'm calculating this. I'm at 4.6. So management said they're more than 3 even as they continue to scale, which my calculations make sense. LTV to CAC, something like 4.6. If you look at it on a trailing 12 months basis, it's sort of more spread out. We're at 3.8 range. So really, really positive to see. Now, how do I calculate that? I use my customer acquisition costs are related to how much the customers are churning, which is a chart we'll look at in a minute, but I calculate that from an annual dollar retention and the changing premium per customer of a customer basis. I don't know how to get into all the details of how I've calculated it, but say your customer acquisition cost is $175. It was something, I think it was like 174 or whatever it was this quarter, roughly was my calculation. And say your premium per customer is 388, which is the current average premium per customer. So say just the average customer comes in the door and buys, gets some policy or policies, and you have 388. And say annual dollar retention is 86%, like we're showing right now. Now, say your loss ratio is 63% for those customers, which is what it was in this quarter. Here's the kicker, right? This equation, what it does is it says it imagines a cohort of a customer, say a group of customers that come in the door. Maybe it's 100,000 customers that come in the door over a quarter, and it says, hey, look, over the span of time, what will be the gross value of these customers? Well, it's going to be whatever they're paying in premiums times by 1 minus the loss ratio. It's basically the leftovers of your loss ratio times by your annual dollar retention to the power of the number of years you're looking at, and then divided by a time value that dilutes the value. It creates a present value of those future cash flows. So this is creating all the future cash flows. This little summation series says you're going from year 0 to year infinity. People have even questions that, well, why do you have infinity? Well, you'll never reach infinity. Long before you get to infinity, this cohort of customers has completely churned away, because it assumes annual dollar retention is, say it's 86%, says, well, every year 14% of your premiums get lost, and then each year it trims down. You have a descending line down to a line that approaches 0, and then it doesn't matter if you add 0 an infinite amount of times, it's still 0. So hopefully people that aren't as into math, I'm not losing you too much, but people that maybe are into math really loving this. But so this is how I'm calculating the LTV, or lifetime value, of a customer, and it's very sensitive to your loss ratio, because you're essentially taking whatever loss ratio and plunk it in there. It's adding that or multiplying it's assuming that loss ratio is the same for the whole life of the customer. That's why, when you looked at this chart on a quarter by quarter basis, it's going to bump up and down. These quarters here, I can guarantee you the reason they're lower, 1.32, is because the loss ratio was higher. And then it even dipped, it'll dip a bit because the loss ratio is higher. That is higher or lower. That's why looking at this on a trailing 12-month basis is a little bit better, because you smooth out some of those variabilities in the loss ratio. But you add all that together and say, I have 6% time value of money and customer acquisition cost of 175, and you're getting an LTV to CAC of 4.3, and it's roughly 4.6 actually is what I had here, I think, because the customer acquisition cost was slightly lower than I have input here. But that gives you a bit of background of how I'm calculating the lifetime value to customer acquisition cost. Now, the other metric and way I'm looking at, the other kind of marketing metric, is I'm looking at your customer acquisition, so what you're spending on growth spend, and how that's converting to in-force premium, the IFP you are acquiring. And I talked about this in some other videos, but in this I excluded the IFP that would have been cross-sold. And it's a bit of a, quarter by quarter, we don't have that figure exactly. It's a bit of an estimate, but as a whole picture, it should balance out to something that makes sense. So I also then have on here a graph of your sales and marketing variable or growth customer acquisition spend. So as you can see, the higher the ratio here, that means you're more effectively converting a customer acquisition dollar into in-force premium. So at one time we're getting, a few quarters ago, getting even over 3. This quarter we got 1.71. Now this is excluding the cross-sell, okay? If you add in the cross-sell, then the values get higher. You're at like above 4, you're at 2 to 3 range. But just for this sake, as I had talked about it in some other videos, excluding cross-sell, you can see that, we're at 1.71 this quarter, which actually is pretty good considering we spent, $36 million on growth spend. So significant amount of spend, still got 1.71 ratio. And this just shows, how effectively you're converting that over. It's different again than LTV to CAC. LTV to CAC, you could argue, is a better metric because it factors in the loss ratio and it really looks at, hey, from a profitability standpoint, how effective, how profitable. Like if you convert a customer that has a 63% loss ratio for their entire life, that's a lot better than converting a customer that has a 90% loss ratio, or a dollar of, and the premiums they have for that 63% is going to have a much better, higher LTV than you would just merely the premiums you got by converting that. So, but it's still a really important and useful metric to look at. And obviously, as the marketing spend goes down, your marketing dollars are more effective and that ratio goes up and vice versa. But it's encouraging to see it's still at 1.71 even after that. That is a large, expenditure. So, and I had done I did a video before where I looked at future projections out to 2032, discounted at 10% and a PE of 30 and a PE of 40, the same chart. And based on, a cross sell of somewhere between 32 to 36% is what I'm expecting. And then the CAC to IFP ratio, like we just saw, say it's a 1.7 or 1.8, something in that range, then, depending where you're picking, you could say the value of Lemonade right now should be between $64 and, $89 a share. Or if you say they're going to command a 40 ratio because they'll still be able to continue growing their earnings at a significant rate, because really they'll still be a relatively small insurance company even at 2032, based on these projections. You could say, oh, maybe they're worth $85 to $119 a share at current present value based on, if a 1.7 ratio, so something in that range. So that's something to look at as well. The net customer growth was interesting. And again, I touched on this right at the beginning of the video. Q4, we saw almost 117,000 customers. Look, Q4 here was one of the lowest customers. Q4 here was one of the lowest customers. Q4 here was one of the lowest customer gains. Q4 tends to almost always be one of the lowest, and Q3 tends to be one of the highest. So it's interesting to see like 146,000 customers in Q3, 117,000 in Q4. I'm going to guess, if we just flip over to premium per customer, you can see there's a bit of a rise in premium. I'm going to flip over to premium per customer. You can see there's a tiny bit of a rise. We went from 384 to 388, but pretty small overall increase in premium per customer. So I'm going to guess they're continuing, as I said earlier in the video, they really are attracting a lot of the sort of pet customers, renter customers, are effectively attracting and gaining those customers in the space. So the question again still is they're really winning in those domains. Can they scale and cross-sell those customers to car and become, not just a $300 a year car renter's customer, but add $1,800 on top of that, and they're a $2,100 renter plus car customer. Can they make that switch? That's really the defining kind of question I think we have for the call tomorrow and for the next quarters ahead. So flipping over here, adjusted EBITDA, as you can see, Q4 was minus 25. Excellent. As they ramped products up and really ramped up their growth spend, adjusted EBITDA looked worse. And now as they've been starting, those investments are paying off. And even still, they're still spending a lot on growth, even accelerating growth, over the last year. And then the next year, adjusted EBITDA continues, the losses become less and less. And as it was mentioned in the letter, they're at minus 25 now. If you took out the $36 billion they spent, they'd be adjusted EBITDA profitable. That's another graph I do want to create, is an adjusted EBITDA minus customer acquisition costs, and it'd be an interesting story because you see that's already flipping to positive. That's something I will add into my model in the future here. Now, adjusted EBITDA divided by gross earned premium, this projects out a couple years where you sort of see this flipping to positive as a ratio of adjusted EBITDA gross earned premium. But you can see here for Q4 where we're still on this sort of this line headed towards profitability. Churn from 12 months prior. So as I mentioned earlier in the video too, I calculate customer churn based on annual dollar retention and changing premium per customer. Churn we had 17%. I think it's rounded up to 17, but it's been pretty steady for the last 4 or 5 quarters as a book of business has held pretty steady. I actually think this could improve a little further as we see CAR rolled out and matured some, because people maybe can bundle the products. They really can get all the products they want and need together, and that could help your churn a little bit. And this is sort of my own version. I've shared this chart before, but those same operating expenses, total operating expenses. So this even includes your growth spend, total operating expenses versus IFP, of course. So some people, a bear might say, oh, get up in arms. I've seen it before. A lemonade bear get up in arms over a chart like this, because operating expenses are done on a quarterly basis and IFP is an annual figure, but it still shows, you can see that there's been only a modest increase, and that would be from the increasing growth spend, and you continue to march upwards in your IFP. This one, IFP per employee, I didn't see the employee figures in the letter, so we'll have to see. We'll get that figure eventually for Q4, but based on, if say they had no customers change between Q3 and Q4, then they went from 731,000 to 776,000 IFP per employee. And remember at Investor Day they talked about how they believe this will march up to 4 million or something in that range, and will really be best in class in terms of IFP per employee. And I wanted to share a little small comment from Tres Comas in my Patreon Discord. So thank you to him. He pointed out, he said that, hey, back at Investor Day, they said on this slide that adjusted EBITDA break even by year end 2026. And then in this letter for Q4, he said, we are to exit 2026 generating positive adjusted EBITDA. So a little more of a positive wording here to suggest, hey, by the end of 2026, they'll be they should be already generating positive adjusted EBITDA versus, this one that shows just break even by year end is sort of what they're predicting. So that was a really great small detail that was noticed. Thank you for that. And finally, my big question is the CAR. Where art thou? Is it tomorrow on the morrow? Is it tomorrow during the earnings call? I pray and hope so, that we get some detailed answers to my questions, because this is a really pivotal part of the thesis. Now, we're doubling down again and again on, I think, what's shown in this letter, that they are the really best in class when it comes to products like renters and pet insurance. But the question still remains, what about the CAR product? Can they convert and become profitable in CAR? And why? What's the problem with these 700,000 people? Even if they're at, 83% loss ratio, isn't that still a loss ratio that you want? And I get it that maybe some of them are in states where you don't want to serve them as much as other states, but shouldn't you be growing CAR, more than simply, let's scroll down and look at this here. Total CAR customers went from 67,000 customers to 68. So you added 1,000 CAR customers. You added 1,000 CAR customers in the quarter. What happened? Now, my thought is maybe some people are churning away. Maybe there's higher churn than they'd like. Or possibly they're purposely dropping CAR customers, like I mentioned. So maybe they are growing in certain states faster and then dropping significantly in other states. That could definitely be a possibility. But CAR, where art thou? We need more details on this really critical product. And so I hope we get that tomorrow. I think we will. We will for sure answer this question. So at a minimum, we'll get answers there. But I hope even other analysts on the call, we really dig into that, because it's such an important part of the thesis. Now, maybe part of the argument you could say is, hey, well, management talked a lot about CAR at Investor Day. That's true. They did talk about CAR quite a bit there. So maybe they thought, hey, that base is kind of covered. But I'd be really curious to hear more about how it's going, even in the last few months since Investor Day. How's the product being received? How well is it doing? So really, really important. That's the only thing I'm kind of looking for. Otherwise, for me, if the stock drops as a whole, I still think, and I'm just going to keep accumulating shares myself, not financial advice, but in my mind, it's a no-brainer that eventually it's going to be worth that present value, say of $100 a share. And if I can buy it at 27, even better deal, I'll continue to accumulate shares. But I do hope we get a lot more clarity. Investor Day was awesome for that, but I still think this letter could have had a lot more. Okay, thank you so much for watching. Again, if you enjoyed all this and you enjoy nerding out about all this, you can join my Patreon. I will continue to make content there. And thank you. We'll listen to the call very closely and have more videos and details coming out soon. But thank you so much for watching. Remember, it's in the bag.